Welcome. Today we're diving into the world of dividends. Whether you're a seasoned investor or just starting out, understanding dividends is key to making the most of your investments. Dividends are payments made by companies to their shareholders, often as a reward for investing in the business. But did you know there are several types of dividends? In this video, we'll break down the most common forms, including cash and stock dividends, and touch on a few lesser-known varieties. By the end, you'll have a clear grasp of how each type works and what it means for your portfolio. Let's get started on this financial journey together. Dividends are essentially a way for companies to share their profits with shareholders. When a business earns more than it needs to operate or grow, it may choose to distribute some of that profit as dividends. This not only rewards investors but also signals the company's financial health. Dividends can be paid in various forms, and each type has its own implications for investors. Understanding these differences can help you make smarter investment decisions and maximize your returns over time. Companies pay dividends for several reasons. First, it's a way to reward loyal shareholders and attract new investors. Regular dividends can make a stock more appealing, especially to those seeking steady income. Additionally, paying dividends can demonstrate a company's confidence in its future earnings. For some businesses, especially those in mature industries, distributing profits as dividends makes more sense than reinvesting all earnings back into the company. This approach can help maintain investor trust and support the company's stock price. There isn't just one way for companies to pay dividends. In fact, there are several types, each with its own characteristics and benefits. The most common are cash dividends and stock dividends, but there are also property, scrip, and liquidating dividends. Each type serves a different purpose and can impact your investment strategy in unique ways. In the next few scenes, we'll explore each type in detail so you can understand how they work and what to expect as an investor. Cash dividends are the most familiar type for most investors. When a company declares a cash dividend, it pays shareholders a specific amount of money for each share they own. These payments are typically made on a regular schedule, such as quarterly or annually. Cash dividends provide immediate income and are often favored by income-focused investors. However, they are also subject to taxes, so it's important to consider the after-tax impact when evaluating your return. When a company announces a cash dividend, it sets a record date and a payment date. Shareholders who own the stock on the record date are eligible to receive the dividend. The payment is then deposited directly into their brokerage accounts or sent by check. The amount you receive depends on how many shares you own and the dividend per share declared by the company. This process is straightforward and provides a tangible benefit to investors. Cash dividends offer clear advantages, such as providing regular income and signaling a company's financial strength. However, there are also downsides to consider. Receiving cash dividends can trigger tax liabilities, and companies that pay high dividends may have less money to reinvest in growth opportunities. As an investor, it's important to weigh these factors when deciding whether to focus on dividend-paying stocks or pursue other strategies. Stock dividends are another popular way companies reward shareholders. Instead of cash, investors receive additional shares of the company's stock. This increases the number of shares you own without requiring you to buy more. Stock dividends are often used by companies that want to reward shareholders but prefer to conserve cash for other business needs. Over time, these extra shares can enhance your investment returns, especially if the company's stock price rises. When a company declares a stock dividend, it announces a percentage increase in the number of shares each investor owns. For example, a 5% stock dividend means you'll receive 5 additional shares for every 100 you already own. These new shares are typically credited to your brokerage account automatically. Stock dividends don't provide immediate cash, but they can increase your ownership stake and potential future returns if the company continues to perform well. Stock dividends can be especially attractive for long-term investors. By increasing your share count, you benefit from the company's future growth without having to invest more money. This can also help you avoid immediate tax consequences, depending on your country's tax laws. Stock dividends are a sign that a company wants to reward shareholders while keeping cash available for business operations or expansion. While stock dividends have their advantages, there are also some drawbacks. Receiving more shares can dilute the value of each share if the company doesn't grow earnings proportionally. Additionally, stock dividends don't provide immediate cash, which may not suit investors seeking regular income. It's important to consider your investment goals and whether stock dividends align with your financial needs. Property dividends are less common but still worth knowing about. Instead of cash or stock, companies may distribute physical assets or securities to shareholders. This could include products, real estate, or shares in a subsidiary company. Property dividends are usually issued when a company wants to distribute non-cash assets or spin off part of its business. These dividends can be more complex to value and may have unique tax implications. When a company issues a property dividend, shareholders receive assets other than cash or stock. For example, a company might distribute shares in a subsidiary or even physical goods. The value of the property dividend is typically based on the fair market value of the asset at the time of distribution. Investors should be aware that property dividends can be harder to sell or value and may come with additional tax considerations. Scrip dividends are another alternative to cash payouts. In this case, a company issues a promissory note to shareholders, promising to pay the dividend at a later date. This approach is often used when a company wants to reward investors but needs to conserve cash in the short term. Scrip dividends may be paid in cash or converted to shares at a future date, depending on the company's financial situation. Scrip dividends, shareholders receive a certificate or note instead of immediate cash or stock. This note represents a promise from the company to pay the dividend in the future, either as cash or shares. Scrip dividends can be useful for companies facing temporary cash flow challenges, but investors should consider the risk that the payment may be delayed or subject to change. Liquidating dividends are paid when a company is winding down its operations. Instead of distributing profits, the company returns part of the original investment to shareholders. This usually happens during mergers, acquisitions, or when a business is closing. Liquidating dividends reduce the company's capital base and are often a sign that the business is ending or changing direction significantly. A company issues a liquidating dividend, it distributes assets to shareholders as part of the process of closing down or restructuring. This can include cash, property, or other assets. Liquidating dividends are typically not considered income, but rather a return of capital, which can have different tax consequences. Investors should be aware that receiving a liquidating dividend often means the company is ceasing operations or making major changes. Special dividends are one-time payments made by companies, usually when they have excess profits or after a significant event like selling a major asset. These dividends are not part of the regular payout schedule and can be a pleasant surprise for shareholders. Special dividends can boost investor confidence and reward long-term holders, but they shouldn't be relied on as a consistent source of income. When a company declares a special dividend, it announces the amount and payment date, just like with regular dividends. However, these payments are typically larger and not expected to recur. Shareholders receive the special dividend in cash or less commonly in stock. It's important to note that special dividends can affect the company's stock price, as the value of the dividend is subtracted from the share price on the ex-dividend date. Dividend reinvestment plans, or DRIPs, allow shareholders to automatically reinvest their cash dividends into additional shares of the company. This can be a powerful way to compound your returns over time, as you acquire more shares without having to make new purchases. DRIPs are popular among long-term investors who want to grow their holdings and benefit from the power of compounding. The DRIP, any cash dividends you earn are used to buy more shares of the company, often without paying commissions or fees. This process happens automatically, making it easy to grow your investment over time. DRIPs are especially beneficial for investors who prefer to let their dividends work for them, rather than taking the cash out for spending. It's important to understand the tax implications of receiving dividends. In many countries, cash dividends are taxed as income, while stock dividends may be taxed differently or deferred until you sell the shares. Property and liquidating dividends can have unique tax treatments as well. Always check with a tax professional to understand how dividends will affect your personal tax situation. There are several important dates to know when it comes to dividends: the declaration date, record date, ex-dividend date, and payment date. The declaration date is when the company announces the dividend. The record date determines who is eligible to receive it. The ex-dividend date is the cutoff for buying shares to qualify, and the payment date is when the dividend is actually paid. Understanding these dates helps you plan your investments more effectively. Dividend yield is a key metric for evaluating dividend-paying stocks. It's calculated by dividing the annual dividend per share by the stock's current price. A higher yield can indicate a more generous payout, but it's important to consider the company's overall financial health. Sometimes, a high yield may signal risk if the company can't sustain its dividend payments. Payout ratio measures the percentage of a company's earnings paid out as dividends. A lower payout ratio suggests the company is retaining more earnings for growth, while a higher ratio means more profits are being returned to shareholders. This ratio helps investors assess whether a dividend is sustainable over the long term. Dividends can be classified as qualified or ordinary, depending on how long you've held the stock and other factors. Qualified dividends are usually taxed at a lower rate, while ordinary dividends are taxed as regular income. Knowing the difference can help you plan your investments and minimize your tax bill. Dividend aristocrats are companies that have consistently increased their dividends for at least 25 consecutive years. These firms are often seen as reliable investments for income-focused investors. Their long track record of dividend growth can provide stability and confidence, especially during uncertain market conditions. Dividend growth investing focuses on companies that regularly increase their dividends. This strategy aims to build a rising stream of income over time, which can help offset inflation and boost your overall returns. Investors who follow this approach often look for companies with strong financials and a history of consistent dividend hikes. While dividend investing can be rewarding, it's not without risks. Companies can cut or suspend dividends if they face financial trouble. High yields may also indicate underlying problems. It's important to research each company carefully and diversify your portfolio to reduce risk. Investing in international stocks can provide access to dividends from companies around the world. However, foreign dividends may be subject to different tax rules and currency risks. It's important to understand these factors before adding international dividend stocks to your portfolio. Real estate investment trusts, or REITs, are known for paying high dividends. These companies own and manage income-producing real estate and are required by law to distribute most of their earnings to shareholders. REIT dividends can be a valuable source of income, but they may also be taxed differently than regular stock dividends. Preferred stockholders often receive fixed dividends which are paid before any dividends go to common shareholders. These dividends are typically higher and more predictable, making preferred stocks attractive to income-seeking investors. However, preferred shares may not offer the same growth potential as common stock. Mutual funds and ETFs that invest in dividend-paying stocks often distribute dividends to their investors. These payments can be taken as cash or reinvested to buy more shares of the fund. This makes it easy for investors to benefit from dividends without picking individual stocks. Companies announce dividends through press releases and investor communications. These announcements include the amount, record date, ex-dividend date, and payment date. Staying informed about dividend announcements can help you plan your investments and maximize your returns. Company's dividend policy outlines how it decides the amount and frequency of dividend payments. Some companies aim for stable, predictable dividends, while others adjust payouts based on earnings. Understanding a company's dividend policy can give you insight into its financial priorities and long-term strategy. Sometimes, companies are forced to cut or suspend their dividends due to financial difficulties or changing business conditions. While this can be disappointing for investors, it's often necessary to preserve cash and stabilize the company. Monitoring a company's financial health can help you anticipate potential dividend changes. Dividend capture strategy involves buying a stock just before its ex-dividend date to receive the dividend, then selling it shortly after. While this approach can generate short-term income, it also carries risks, such as price drops after the ex-dividend date. It's important to weigh the potential rewards against the risks before trying this strategy. Many investors use dividend-paying stocks as part of their retirement strategy. Regular dividend income can supplement other sources of retirement funds and provide financial stability. Choosing reliable, well-established companies with a history of consistent dividends can help ensure a steady income stream in retirement. When evaluating dividend stocks, consider factors like dividend yield, payout ratio, company financials, and dividend history. Look for companies with sustainable earnings and a commitment to rewarding shareholders. Diversifying your holdings can also help manage risk and improve your chances of long-term success. There are several myths about dividends, such as the idea that high yields always mean better investments or that dividends are guaranteed. In reality, high yields can signal risk, and companies can cut dividends at any time. It's important to base your investment decisions on careful research and a clear understanding of the facts. Building a dividend portfolio involves selecting a mix of stocks, funds, or other assets that pay regular dividends. Consider your income needs, risk tolerance, and investment goals. Reinvesting dividends and regularly reviewing your portfolio can help you achieve steady growth and income over time. Keeping track of your dividend income is important for managing your investments and planning your finances. Many brokerage platforms offer tools to monitor dividend payments, yields, and reinvestments. Staying organized can help you spot trends and make informed decisions about your portfolio. Common mistakes in dividend investing include chasing high yields without considering risk, failing to diversify, and ignoring company fundamentals. Avoiding these pitfalls can help you build a more resilient and profitable dividend portfolio. Focus on quality, sustainability, and long-term growth. Let's quickly review the main types of dividends we've covered: cash dividends, stock dividends, property dividends, scrip dividends, liquidating dividends, and special dividends. Each type has its own features, benefits, and risks. Understanding these differences can help you make smarter investment choices and build a stronger portfolio. Congratulations, you now have a solid understanding of the different types of dividends and how they can impact your investment strategy. Whether you're seeking regular income, long-term growth, or a mix of both, knowing how dividends work is essential. Take the time to research your options, consider your financial goals, and build a portfolio that suits your needs. Thanks for joining us on this journey through the world of dividends.